What if I told you that most traders don't lose money because they know too few strategies? They lose because they use the right strategy at the wrong time. They see Fibonacci and buy. They see RSI below 30 and buy. They see a breakout and chase it. And then the market does what it always does. It proves them wrong. So in this video, we're going to break down 22 of the most important trading strategies and concepts. But I'm not going to simply explain what they are. For every strategy, I'll show you what it does, where traders make mistakes, and when it actually makes sense to use it. And stay until the end, because I'm going to take all 22 strategies and compress them into one simple 3-step trading framework. If you understand that framework, you won't need to put 20 indicators on your chart just to find one trade. Let's start. 1. Fibonacci Retracement. Let's start with one of the most popular tools in technical analysis, Fibonacci Retracement. The idea is simple. Price makes a strong move, then it pulls back. Fibonacci helps you identify potential areas where that pullback could react. The commonly watched levels are 38.2%, 50%, and 61.8%. But here's the mistake. Price touching 61.8% does not mean you should automatically buy. Fibonacci tells you, pay attention here. It doesn't tell you, enter now. The best setups happen when Fibonacci overlaps with something else, such as support, an order block, a trend line, or a structural level. So remember, Fibonacci gives you the location. Price action gives you the confirmation. And that distinction is going to come back again and again throughout this video. 2. Breakouts. Now imagine price has been trapped between the same resistance and support for hours, or even days. Then suddenly, boom, price breaks out. Most traders immediately jump in, and that's exactly where the trap can begin. Because markets produce plenty of false breakouts. Price can break above resistance, trigger breakout buyers, take liquidity, and then collapse straight back into the range. So instead of asking, did price break the level? Ask, did price prove the breakout? Look for a strong close outside the range. Look at momentum. Look at volume. And if possible, wait for a retest. Resistance breaks. Price comes back. Resistance becomes support. Buyers defend it. That reaction is often more useful than chasing the first breakout candle. 3. Reversal patterns. Now let's flip the idea. Instead of trading continuation, what if the trend itself is dying? That's where reversal patterns come in. One of the most famous is the head and shoulders. You have a left shoulder, a higher head, and a right shoulder. But here's the important part. The shape itself isn't the trade. The neckline break is the confirmation. The same idea applies to double tops and double bottoms. 2 failed attempts to break a level show potential exhaustion, but you still need confirmation. So never enter simply because you can draw a pretty pattern on your chart. Because here's a brutal truth. A pattern isn't confirmed until price proves it. 4. Elliott wave. Now things get more interesting. Elliott wave theory suggests that markets can move through recurring cycles driven partly by crowd psychology. A basic impulse contains 5 waves. Wave 1 begins the move. Wave 2 corrects. Wave 3 often becomes the strongest directional phase. Wave 4 corrects again. And wave 5 completes the impulse. Then comes an ABC correction. The famous rule? Wave 3 cannot be the shortest of waves 1, 3, and 5. But there's a trap here. Don't become obsessed with counting every tiny wave on a 5-minute chart. Different traders can interpret the same chart differently. Use Elliott wave as a framework for understanding where the market may be within a larger cycle, not as a crystal ball. 5. Fair value gaps. Now let's talk about something that has become extremely popular in modern price action, fair value gaps. Imagine 3 candles. The middle candle makes a powerful move, and between candle 1 and candle 3, there is an area where price didn't trade efficiently. That area becomes the FVG. Many traders watch for price to return to that zone. But here's something you need to remember. An FVG is not a guaranteed magnet. Some get filled. Some get partially filled. Some don't get revisited at all. So instead of blindly placing an order inside every FVG, wait, let price return, then watch the reaction. If the FVG aligns with market structure, support, demand, or another confirmation signal, now you have something much more interesting. Location first, confirmation second. Keep that formula in your head, because we're going to use it again. 6. Candlestick Patterns. Now let's zoom in. Forget indicators for a moment. Look at the candle itself. Every candle tells you open, high, low, close. A pin bar can show rejection. An engulfing candle can show a sudden shift in short-term control. 3 white soldiers can show persistent bullish pressure. 3 black crows can show persistent bearish pressure. But there's one thing more important than the pattern. Where did it happen? A bullish pin bar in the middle of nowhere? Not very interesting. A bullish pin bar at major support after price sweeps a previous low? Now you've got context. So don't ask, what candle is this? Ask, why did this candle appear here? That's the difference between memorizing patterns and actually reading price action. 7. Heikin Ashi. Here's a chart that can make a messy trend look surprisingly clean. Heikin Ashi. It uses modified calculations to smooth price action. That means fewer visual distractions. During strong bullish trends, you may see consecutive green candles with little or no lower wick. During strong bearish trends, you may see red candles with little or no upper wick. This makes Heikin Ashi useful for one thing in particular: staying with trends. Instead of panicking every time a normal candle pulls back slightly, you can use the smoother structure to remain in the trade. But there's a catch. Heikin Ashi doesn't show the exact open and close in the same way as standard candles. So use it for trend visualization and trade management, and use standard candles when you need precise price information. 8. Moon phases. Okay, this next strategy is definitely different. Moon phases. Some traders study full moons and new moons as potential timing windows for changes in sentiment or volatility. But let's be very clear. This is an experimental concept, not something you should use as a standalone trading signal. There isn't strong enough evidence to say full moon equals market top or new moon equals market bottom. If you want to experiment with lunar cycles, use them only as a background timing filter. Your actual decision should still come from price, structure, risk, confirmation. Because your trading account doesn't care what phase the moon is in. It cares whether your trade works. 9. Renko charts. Now let's completely change the way price is displayed. Traditional candles are heavily tied to time. Renko focuses primarily on price movement. A new brick forms only after price moves a predetermined amount. That means much of the small sideways noise disappears. You get something that can look almost like a staircase. Up, 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 until the direction changes. This can make trends easier to visualize, but brick size matters. Too small? Too much noise. Too large? You lose important information. So Renko can be useful for trend identification and filtering noise, but don't confuse a cleaner chart with a more predictable market. The chart becomes simpler, the market doesn't. 10. Harmonic Patterns. Now we're getting precise, very precise. Harmonic patterns use specific Fibonacci relationships between price swings. Some famous examples include Gartley, bat, butterfly, crab. You typically work with points X, A, B, C, and D. Point D forms the potential reversal zone. But here's the mistake that destroys harmonic setups: forcing the pattern. If the Fibonacci ratios don't match, it's not the pattern. Don't bend the rules just because you want to trade. And even when price reaches the PRZ, don't blindly enter. Wait for confirmation, a rejection candle, a structure shift, momentum confirmation, something that tells you price is actually reacting. The PRZ tells you, watch this area. It doesn't say, enter immediately. 11. Support and resistance. Now let's go back to one of the simplest and most powerful ideas in trading: support and resistance. Support is an area where buyers have previously stepped in. Resistance is an area where sellers have previously stepped in. But don't think of them as perfect lines. Think of them as zones. And here's the really useful part: role reversal. Resistance breaks, price retests, and that old resistance can become new support. The opposite can happen with broken support. This gives you a simple setup: level to break, to retest, to reaction. Sometimes the simplest concepts are the ones traders overlook because they seem too easy. 12. Dynamic support and resistance. But what if support and resistance aren't horizontal? That's where dynamic levels come in. Moving averages are the obvious example. The 20 EMA can help traders visualize shorter-term momentum. The 50 EMA can provide a medium-term reference. And the 200 EMA is widely watched for longer-term trend context. Price can repeatedly react around these moving averages during strong trends. But don't make this mistake. Price touched the 20 EMA, so buy. No, the EMA is not magic. It's a reference. Combine it with structure and price action, and suddenly a moving average becomes much more useful. Now take support and resistance and rotate it. You get trend lines. An uptrend can be visualized by connecting higher swing lows. A downtrend can be visualized by connecting lower swing highs. 2 points create the line. A third meaningful reaction can provide stronger evidence that the market is respecting it. But eventually, the line breaks. And that's where traders often get excited too early. A trendline break doesn't automatically mean trend reversal confirmed. It means something changed. Now look for a retest. Look for structure. Look for confirmation. Because the line breaking is information. The reaction afterward is the trade. Now we enter one of the more specialized areas of technical analysis: Gann angles. W.D. Gann's framework attempts to relate price movement and time through geometric relationships. The famous 1-by-1 relationship is often associated with a 45-degree angle when the chart is properly scaled. Other relationships include 2-by-1 and 1-by-2. Traders use these angles as potential dynamic support, resistance, and trend references. But there's a major caveat. A visual 45-degree line doesn't automatically have the same meaning on every chart. Scaling matters. So if you're going to use Gann techniques, learn the methodology properly, rather than simply drawing random diagonal lines and calling them Gann angles. Specialized tools require specialized understanding. Now we've talked about where price might react, but here's the next question: how strong is the move? That's where momentum indicators come in. ROC measures the rate of price change. MACD compares moving averages to help identify momentum and trend conditions. And here's a powerful concept: price makes a new high, but momentum doesn't. That can be a warning. It doesn't guarantee that the market will reverse, but it tells you this move may not be as strong as it looks. And when that warning appears at major resistance, now you're paying attention. Now let's talk about RSI and Stochastic. These indicators are especially popular because they're easy to understand. RSI above 70, many traders think sell. RSI below 30, many traders think buy. And that's exactly the problem. During a powerful uptrend, RSI can stay above 70 for a long time. During a strong downtrend, it can remain below 30. So overbought doesn't mean price must fall. Oversold doesn't mean price must rise. In a ranging market, however, these levels can become much more useful. The lesson: never trade an oscillator level without understanding the market environment. Now imagine price is making higher highs, but your RSI is making lower highs. Something doesn't match. That's divergence. Bearish regular divergence can warn that bullish momentum is weakening. Bullish regular divergence is the opposite. Price makes a lower low, while the indicator makes a higher low. But here's the catch. Divergence can appear long before price actually reverses. So don't immediately short every bearish divergence. Instead, treat it as an alert. Then wait for something else: a structure break, a trendline break, a reversal candle, or a failed breakout. Divergence says, be careful. Confirmation says, now you have a trade idea. Now let's answer another important question. How much activity is behind the move? That's where volume comes in. A price breakout on very weak activity may be less convincing than a breakout accompanied by strong participation. OBV combines price direction and volume into a cumulative measure. Volume profile gives you a different perspective by showing how much trading occurred at different price levels. One important reference is the point of control, or POC. This is the price level with the highest traded volume within the selected range. Volume can also become interesting when you see an unusually large spike but relatively little price progress. That can suggest heavy two-sided activity or absorption. But remember, volume doesn't tell you everything. Price plus volume plus structure is much more useful than volume alone. 19. Supply and demand. Order blocks. Now we're getting into modern price action concepts. Supply and demand zones attempt to identify areas where strong buying or selling previously influenced price. In smart money concepts, traders often use the term order block for specific price structures associated with strong displacement. A commonly used bullish order block is the last bearish candle before a strong bullish move that breaks meaningful structure. A bearish order block is the opposite. But here's the trap. Not every candle before a big move is an order block. You need context. Was there strong displacement? Was meaningful structure broken? Was the location important? If price later returns to that zone and shows confirmation, now the setup becomes interesting. Again, location first, trigger second. 20. Market structure. Everything we've discussed so far becomes much easier when you understand this. Market structure. Bullish structure. Higher highs plus higher lows. Bearish structure. Lower highs plus lower lows. That's the foundation. If the higher time frame structure is bullish, why are you constantly looking for shorts? If the structure is bearish, why are you desperately searching for longs? And if the market is ranging, don't force a trend where there isn't one. Before using any indicator, before drawing Fibonacci, before looking for an FVG, ask one question. What is the market structure? Because strategy comes after context. 21. Boss and Stochastic. Now we're at the point where market structure becomes actionable. A break of structure, or BOS, is generally used to describe a break of an important swing point in the direction of the existing trend. Bullish trend, price breaks a meaningful previous high. Bearish trend, price breaks a meaningful previous low. Then we have CHoCH, change of character. This is used to describe a potential shift in market behavior. For example, the market has been making higher highs and higher lows. Then price breaks an important higher low. That can signal a potential bearish change of character. But don't confuse a wick with confirmation. A temporary spike through a level can simply be a liquidity sweep. You want evidence that price has actually changed its structural behavior. And even then, CHoCH doesn't guarantee a complete trend reversal. It's an early warning. 22. The Master Framework. Now, this is the part I want you to remember. Because after 21 strategies, you might be thinking, do I really need to use all of these? No, absolutely not. In fact, trying to use all 22 on every trade can make your analysis worse. Instead, organize them into 3 layers. Layer 1, direction. Start with market structure. Then use tools like trend lines, moving averages, higher time frame price action. Your first question is bullish, bearish, or ranging. Layer 2, location. Now find the area where a trade could make sense. Look at support and resistance, supply and demand, order blocks, Fibonacci, fair value gaps, harmonic patterns. Now you have a location, but still, no trade yet. Layer 3, trigger. Now wait, don't predict. Wait for price to show you something. Maybe it's a CHoCH, a breakout and retest, a candlestick reversal, a volume reaction, momentum confirmation, divergence. Now you have direction, location, trigger, and that is the framework. The example. Let's say the higher time frame market structure is bullish. That's your direction. Price then pulls back into a major support zone that also overlaps with a Fibonacci retracement and an FVG. That's your location. Then, on the lower time frame, price sweeps a previous low and breaks short-term bearish structure to the upside. That's your trigger. Now, and only now, do you start thinking about the entry. Your stop goes beyond the level that invalidates your idea. Your target is defined before you enter, and your position size is calculated from your risk, not from how confident you feel. Final message. And this is the biggest lesson from all 22 strategies. You don't need to predict every move. You don't need 10 indicators, and you definitely don't need to take every setup. Your job is much simpler. Find the direction, find the location, wait for the trigger. Then manage your risk. Because even the perfect-looking setup can fail. That's why risk management matters. A common guideline is to risk only a small percentage of your account on any single trade, often around 1 to 2%, depending on your strategy and risk tolerance. And remember, one trade means almost nothing. 10 trades can still be noise. Your edge becomes meaningful over a large sample of trades. So don't build your trading career around finding the perfect trade. Build it around finding a repeatable process. Because the best trader isn't the person who predicts the market every time. It's the trader who knows when to enter, when not to enter, where the idea becomes invalid, and most importantly, how much they're willing to lose when they're wrong. That's the real framework behind all 22 strategies.